Hello, everyone, and welcome to another exciting talk from the Oxford Guild with our Collegium Global Network and our partner societies from leading universities. We're truly honored today to be hosting this special online event with a truly esteemed guest, Professor Robert J. Shiller, who's a world-renowned Nobel Prize-winning economist. He's widely considered to be one of the most influential financial minds and economists in the world, and one of the founders of and leaders in behavioral economics and behavioral finance, incorporating psychology into economic thinking and setting the standard for much of the approach to the discipline today. He famously successfully predicted both the dot-com crash and the 2008 crash in the US housing market that led to the global financial crisis, leading to some dubbing him the original Dr. Doom. We're hosting today's event in the midst of another global financial crisis, and it'll be fascinating to hear Professor Schiller's views on what lies ahead. Today, in addition to answering your questions, he'll be discussing some fascinating topical issues around narrative economics, how stories go viral and drive major economic events, which is also the title of his latest book. Thank you very much again, Professor Shiller, for taking the time to join us today and to share your insights. And over to you. The floor is yours.
Thank you. Well, before I begin, I thought I would take note of some news just today, of the Nobel Prize in Economics. If you can turn to the next slide. This is won by Robert Wilson and Paul Milgrom, both at Stanford University. I think it's an inspirational moment because these are people who make a difference. They use economic theory to propose new mechanisms that will allow economies to work better. In their case, for example, the way radio frequencies are auctioned off to businesses has reacted to their theory. And a lot of the latest Nobel Prizes have been for people who make a difference. Last year, it was Esther Duflo and Abhijit Banerjee, and also Michael Creamer, who all had proposals for things that could be better. It's a long story. Al Roth won it for a method of allocating kidney donors. And Eric Maskin won it for alternative ways of running elections, all extremely important topics. And to me, it is a good moment this morning. They are exhibiting face masks in this picture, which makes it look a bit comical. But you have to be willing to be laughed at sometimes. What they're doing is modeling good behavior during a pandemic. Next slide. So I'm going to talk about epidemiology. I wrote my latest book. Actually, it was most of my presidential address before the American Economic Association 3 years ago. I think that economists have to listen more to narratives, especially true in this fake news era where everybody mistrusts everybody. But we have to listen to what people are saying. This is a branch of behavioral economics. It's the branch that looks at what people are saying now or at various times in history. We have to recognize that ideas go viral just as diseases do. Well, that's not an entirely new theory at all. It goes back over 100 years, but they don't really incorporate it into economics, not very often. So the problem is that people change their thinking. They don't all maximize a consistent utility function all through time. They're different at different times. And they're affected by narratives, by stories. They don't look at diagrams very much or statistics very much. I'm talking about the narratives of ordinary people who are not trained in economics, but who make most of the economic decisions. And so that's an important thing that is under-researched in economics, but it's coming in. It's starting to come in. And I think it's affecting all social sciences. People are more thinking that they have to take account of what the public thinks. And so I'm going to, in this talk, I'm going to just give you a little bit about COVID-19 as an example of an epidemic. It's actually, as I said, a co-epidemic with an economic narrative epidemic. And I want to talk also finally about what is really happening now. Why are the stock market, well, especially the U.S. stock market, why is it so high right now? at a time of great turmoil with the virus and the, in our case, a very disputed election coming up in the United States. And yet the United States has the best performing stock market of any major country in the world. What is going on here? So next slide. Oh, I have some disclosure. I have a consulting relationship with Barclays Bank in the UK, but I'm not going to advertise any of my products here. I've talked about this before in the AEA presidential address. I said that, and in my latest book, Narrative Economics. Next slide. So I just wanted to remind you what an epidemic looks like, and I thought to make it most vivid, I would show it for the UK, but I could get diagrams like this for practically any country in the world, or something like this. This is a plot of the number of new cases in the United Kingdom, starting in March 6th of this year, up to the present. I took this off the government website not long ago, a few days ago. So what is striking is that on the left-hand side, that's in March, April, May, the pattern is a hump-shaped. It rises and then falls. And then that's called an epidemic curve. Why does it rise for a while, for a matter of, in this case, weeks, and then fall, or months, and then fall? It has to do with contagion and recovery. In the rising period, the contagion rate is higher than the recovery rate. And so the number of cases keeps growing. After a while, something happens to the contagion rate and it falls, and contagion falls below did I say that right? Falls below the recovery rate. So people are just getting over it. And it tends to decline asymptotically, unless something brings the contagion rate back up or the recovery rate down. So the bizarre thing that's happening in the UK is the number of cases is being recorded is shot up in what we call a second wave on the right-hand side. And this second wave is looking very pronounced in the UK. But don't get too alarmed. If you go to the next slide, you probably know this, but let me just, there's a similar curve for deaths due to COVID-19. And the death rate has started to pick up on the right-hand side. It matches somewhat the diagram that we just showed you for cases, new cases, but it's picking up on the right-hand side, but only a little. And there's a number of reasons for this that have been talked about a lot. So one of them is they're testing more in the UK, and so they're missing less people. They have a better cure. They have dexamethasone, which was just used on our President Trump and seemed to miraculously cure him. So deaths are not as related as they were before. The population is younger, who are less afflicted, less bothered by this insight. And hospitals are more prepared and less overwhelmed. So all of those make for a difference. But I'm not really showing these diagrams to scare you about COVID-19. I'm doing them to illustrate the typical epidemic curve, which is seen again and again. Next slide, please. Here's just one more example. This is New York City. It's the same story that we see in the UK. It's a hump-shaped curve, and then it died out. It looked like it was gone, and now it's starting to come back. You can just barely see the uptick in the right. But why does it happen? Why? I think it's largely variation in the contagion rate. And the people were satisfied that New York is safe around the middle of the diagram, and so they stopped taking precautions. And so it's starting to come back. But I think that the same pattern applies to ideas, especially ideas that are attractively packaged as narratives. If you go to journalism school and you learn how to write newspaper articles, they will tell you, put human interest right up front. Don't put a statistic right up front. You put some story of John and Sally who caught this disease and what their story was. Embellish it with irrelevant details, because that human details or visual images, and those things attract attention. And then make it possible that your story will go viral. People will start forwarding it all over the place. And if you get it right, you can be the most famous person in the world for a while. That's an epidemic. And I think that's what's happening with world economies in major events. Next slide. What we're taught to study in economic or macroeconomics is fluctuations in say gross domestic product. So I have here the blue line is the gross domestic product for the United States from 1929 to the present. And the orange line is consumption expenditures, which is a fraction of GDP. This is printed on a log scale, so it makes epidemic or exponential curves look like straight lines. But you can see those little wiggles, and they're both kind of straight lines going up. Well, the biggest wiggle is at the left. That's the Great Depression. And everything fell quite dramatically. The next biggest wiggle was World War II. And you can see consumption and GDP went in opposite directions because they were putting so much into military and they weren't eating well. Latest big wiggle is the COVID-19 drop. You see that at the far right? So suddenly it's pretty big, not as big as the Great Depression. I think we have to focus on big events and we want to know where this is going. It may be well that this will recover quickly. We were getting better treatment of COVID-19. We're less afraid. So maybe that thing will shoot up in the third quarter. But that's the question. The question is why all those wiggles occur. Next slide. The same thing is true of the stock market. Here's the stock market in the US. The blue line is stock prices from 1871. This chart stops in December. It's kept going up even more after that, and in terms of earnings. But the wiggles in the stock prices don't reflect wiggles in earnings. They don't. Sometimes they do, but not reliably. So something is going on. What is that? Well, efficient markets people say it's somehow the market processes information about future earnings. I don't think that's the major cause of fluctuations. I'm going to say it's changing stories and narratives. Next slide. This is the same. This is home prices in the United States. They actually look rather similar in the UK at times, but this is back to 1890, and they show these big fluctuations through time. But it's not caused by a changing demand for housing versus supply, because real rent on rented houses hasn't done much. You can see on the right, the gray line. So I'm arguing in my books that these things are mainly due to epidemics of narrative. These wiggles you see, they look like a narrative epidemic curve. Well, that's because they are an epidemic curve, at least in part. It's not all the mechanisms of interest rates and trading. It's people's thinking that drives these things. So next slide. So I'm not going to dwell on this, but epidemic models like the Kermack-McKendrick model are now over 100 years old. But they embody this is the simplest model of an epidemic, where you divide the population into susceptibles, infected, and recovered, and S, I, and R. And they all follow a differential equation. But just in quick, the center equation shows that the contagion rate, which is CS, minus the recovery rate, times the number of infected, is the number of new infections. So the infections will go down if CS is less than R, and they'll go up if CS is greater than R. It's the basic intuition of epidemiology. And this model, even though it's 100 years old, it is subject to modifications still used by epidemiologists today. Next slide. And it shows an epidemic curve. The solution to the model, if you look at the black line, that's the number of infectives. If contagion rates and recovery rates stay constant, eventually the epidemic peaks, even if there's no change in the contagion parameter C, because there's fewer susceptibles S, and eventually it dies out. And the orange line is new cases. So that's what we've been seeing. It's the Kermack-McKendrick model again, reappearing. So I'll give you an example. Next slide. The idea of a fair wage and saying that employers are unfair was an epidemic that started growing in the late 19th century. It grew up and got a special impetus. The peak occurs during the Great Depression. Everybody was saying it was unfair. They weren't being paid a fair wage. But that epidemic eventually dropped out, and it was replaced by the idea of a market wage. But nobody ever said a market wage, or hardly anyone said it in the 19th century. Just people's whole views of what's going on. They think there's a moral dilemma in people's paying of wages. They don't think of it in terms of the mathematical models that are familiar to economists. Next slide. This is a slide showing the frequency of the term labor union, another epidemic curve. They keep coming up. I mean, not always, but very commonly. So labor was a big thing, especially in the Great Depression. And feeling that wages were unfair provoked lots of strikes. It polarized society. There were pro-union and anti-union. You had the Labour Party gaining in the UK, but it's changing now. It's fading away. We have different ideas. That's the thing we have to study if we want to understand the economy. Next slide. So this is about why do people dislike inflation? I wanted to just emphasize, I did this question, it's kind of long to read, but it was asking, what do you think your employer will do to your pay if there's a lot of inflation in consumer prices? And I asked the same question of randomly selected Americans and of economists. And the economist's favorite answer was number 2, what will happen with inflation? Competition among employers will cause my pay to be bid up. I could get outside offers, so my employer will have to raise my pay too. 60% of economists liked that when I asked it. Only 11% of the public. They thought in moral terms. They thought if your employer is a nice person, they will raise your wage. But maybe they're not a nice person, and maybe they won't raise my wage, so we have to fight. That was the conflict of that time. We've just kind of forgotten about it. I mean, some people still think about these things, but it's faded away. So I want to get ideas now, what's happening now. Next slide. Actually, go ahead to one more slide. This is about the narratives that are in force today. And I feel a little bit less expecting to surprise you, because this is recent years I'm talking about. And the narratives are well known. It's more of an epiphany if you look at narratives from other times, like the Great Depression, which it was. There were some people thinking in our modern terms, but not many. It was different. But I'm not going to look further back as I do in my books. But I'm going to look at just relevant things happening now. I'm doing it in 2 parts. I'm doing the longest expansion for the United States was from, well, it ended just this year. It was 10 years. So it was from 2000, a little over 10 years, 2009 to 2020. But I'm going to look at the expansion in the period just before it. So I've numbered those different episodes. 2003 to 2007 was a stock market boom and a strong economy. 2007 to 2009 was the famous financial crisis, the Great Recession. 2009 to 14 was the slow and long expansion from these things. And then at the end of this period, the unemployment rate in the United States fell to a peacetime record low. You'll find similar things in the UK, but I'm going to focus here on the US. The next slide. So I've got a lot of narratives here. These are mostly from my book, Narrative Economics. I'm just going to race through these because I think you know these already, but we just have some enlightenment about how big they were when. So next slide. Donald Trump. Okay, I don't know if you maybe you talk a lot about Boris Johnson. I don't know. I'm not there in the UK, but I'm just stunned by how many times people talk about Donald Trump. He's like everything is about him all of a sudden. But we forget that it was different when we had our first minority president, Barack Obama. He was talked about quite a bit. He was pretty dramatic, being the first minority to make it to the presidency, and very controversial at the time. Some people fell in love with him. Other people were resentful. But Trump has trumped Obama. He's gotten bigger even than that. The preceding president, George Bush, not much interest in him. Nothing new here. It didn't launch a narrative epidemic. So let's see what some of these epidemics were. Next slide. The strong economy. We go to the next slide. It's about a strong economy narrative. The term strong economy is kind of new. I don't know why it's not advancing. I'll go ahead anyway because I don't have time. There's some idea that has developed that the economy is driven by an internal strength. And our own president, Donald Trump, has presented himself as he's a tall, big, strong man. He had to get out of his COVID-19 hospitalization fast because that was essential to his narrative. If you want to read about the Trump narrative, read his book, The Art of the Deal, or any of his books, or How to Be, I don't remember the titles. But he tells you to keep your story alive and keep telling it. Good advice if you want to get ahead, and that appeals to you. So I don't know why it's not advancing. Oh, here, next slide. Okay, you can see how a strong economy has grown, and over-speculation has faded since the year 1800, or since 1900. Next slide. It's about fake. Oh, by the way, my next slide. Yeah, 62% of Proquest news and newspaper hits. Looking at a digital index of English language newspapers, 62% that had the word strong economy also mentioned Trump. Differently, in another strong economy in the late 1990s, only 27% of the news and newspaper hits for strong economy mentioned the then president. The president's slogan wasn't "Make America Great Again." It was putting people first. It didn't have the patriotic and we're the strongest story to it. So it somehow appealed to people. It was part of the Trump narrative, and he's got to keep it going. He's got to have a strong economy for the upcoming election. Next slide. This is a really big, it's fake news. Hardly anyone talked about fake news. There was talk about it during World War II. The Nazi regime was making fake news and trying to influence people. and telling them, don't trust the lying media. They said in German, die Lügenpresse. Now we say lying mainstream media. This is an extremely important narrative that came in suddenly with the, this is a Google Trends count from the 2004 to the present. Suddenly it came up. I think this is of huge economic damage, this narrative, because it means it's really a time of loss of trust. And you can't do business well without trust. It hasn't hurt things yet, but I think it has the potential to. Next slide. The Great Depression. This is from a slide from my book. It has been gaining, well, this is actually from my book, which came out in last year in 2019. But you can see that there was a huge uptick in news stories about about the Great Depression. And that's why we even named it the Great Recession. There's so many vivid stories. We love this it's a legend. The legend has been growing steadily of the Great Depression. It's been growing steadily along a long, slow epidemic curve until it was triggered by the financial crisis. And epidemics it's like a mutation in a virus. Epidemics can suddenly gain life. And you can see that in the middle where the arrow for news and newspapers points. And it's coming back, but we don't quite see the latest. This doesn't show the COVID-19. We'll come back to COVID-19 in a minute. Next slide. I have too many slides here. But I have a lot of slides because there's a lot of narratives, and it's the sum total of all of their effects that matters. Consumer confidence is a narrative about consumers being scared and not wanting to buy, or business confidence. And they're growing a lot now, which means we're looking at each other more than ever before. We're looking at each other to see if we're confident. If you see other people aren't confident, you get loss of confidence yourself, and you'll spend less. So somehow the Trump revolution in the U.S. and maybe the Boris Johnson revolution, I don't know, but those have encouraged a sense that other people are confident. Next slide. Trade war. The term trade war is new, or it was used occasionally, but look at the spike recently. Actually, the term trade war was used with other meanings before. When during World War I, they referred to the trade war as the war carried on by disrupting trade. You have to watch that in counting phrases. They do change meaning in time. Next slide. Sustainability-Frugality Narratives. This is sustainable living. It's been on a long, slow epidemic curve for decades, but it has peaked in the early around 2009, and it's coming down since. Similarly with sustainable lifestyle, but it's picking up at sustainable living is picking up at the end. And I haven't, this is not as up to date as my other slides. But next slide. It's helped along recently by Greta Thunberg, who sailed across the Atlantic in a stunt. She and her father have a good eye for viral narratives. And she is about the most famous woman in the world. She's 17 now. I'll come back to her. But that's why it get viral, is going viral recently, I believe. 7, next slide, debt and default narratives. Fear of debt was rising after the financial crisis in 2008 and 2009, and it's begun to be forgotten. So part of the reason why there was the long expansion is that the fears of debt at the beginning are being forgotten. So if you go next slide, I don't have time to read all this, but newspapers were giving a lot of stories in 2010 about debtors who regretted buying a bigger house than they should have because now they're in trouble. Next slide. They talked also in the later recovery about boomerang buyers. We've forgotten this. A boomerang buyer is someone who lost their house in the financial crisis and has come back. Next slide. New normal and secular stagnation were popular after the Great Depression. Secular stagnation was an outlook for the future that would be forever bad, but that's being forgotten. Next slide. Real estate bubble narratives. Hardly anyone called them a bubble until late 19th century. And then it's especially prominent now. This is in news and newspapers. So next slide. In 1915, one writer in a book called The History of California talked about why we don't say real estate bubble. And he said it's because it's effeminate. Boom. I don't know if this is early 20th century thinking about women. Somehow bubble seems weak. Let's call it a boom, and it would suggest prosperity. Next slide. Automation and artificial intelligence narratives. Well, the latest is artificial intelligence, which is clipped away by COVID-19. But it's in another sense, it's enhanced by COVID-19 because as the epidemic progresses, we have more interaction via computer, what we're doing right now. There's more virtual reality all of a sudden in many places. So I worry about this new, the artificial intelligence narrative as a source of anxiety and loss of hope for one's economic future. Has been in and out. I suspect it could come back after COVID-19. If more people are out of jobs, it could seem like a permanent thing and it could be back into a Great Depression. You see, I'm thinking about how to forecast the possibility of a Great Depression. And I'm not doing mathematical manipulation of interest rates, and I'm looking at what people are thinking and what might scare them, which is different. So now finally, I just have to rush through this. I'll open this for questions in a minute. Next slide. Actually, go again, another slide. Look at the comparison of the US and the UK for the stock markets. This is from a paper I just wrote with the Barclays Bank colleague and another colleague of mine. The red line is the stock market since the beginning of this year, or since December. You can see that the US market is way up. The UK market is still down. Why is that? Well, we looked at the sectors, and we find that one reason why the US market is doing so well is because of the sector called information technology. That's the orange thing on the left. The UK doesn't have much of an information technology sector, so that helps explain why the UK stock market hasn't done nearly as well as the US stock market. But on the other hand, it looks like all of the sectors are doing poorly, relatively speaking, in the UK. And why is that? I think it must have something to do with different narratives. Now, I haven't finished researching UK narratives, so this is going to be a little biased toward the US. But just quickly, we go forward. Next slide. I'm identifying just this year different subperiods. A is pre-crisis between until January 30, when the World Health Organization first announced the coronavirus as a crisis. The second is the COVID expansion. After announcing that it's a public health emergency, the market continued to go up between January 30 and February 19. Then there was a crash from February 19 to March 23rd. It was just about a month. It went down over 30% in a month. That's pretty dramatic. And then there was a V-shaped recovery. That's period D. But anyway, the thing to remember for the following slides is C is for crash. That's when the market was crashing this year. You can see it in the next slide. This is a plot of the S&P 500 this year. And you can see the white shaded, the white area is the boom before the crash. And then B is the upswing that until the peak of the market in February 19 of this year. And then you see the crash. That's it says A, B, C, D. You see, so then C is going down during the crash, and then you see the big upswing to a new record high in September of this year. So I'm going to understand in terms of the changing narratives these different phases in the market. Next slide. So I have a bunch of, actually, this is just up to date. You can skip past this. The market was down for a week or so, and now it's back up. It's almost at a record high now. As of this morning, I haven't checked for the last few minutes. On the right-hand side, I filled out the narratives in the 2020 period. Coronavirus, pandemic, Donald Trump, American dream, American greatness, Great Depression, quantitative easing, and trade war. I forgot to mention that narratives thrive on patriotism. And so these are patriotic narratives for the US. I apologize for this, but it's reality. Next slide. So this is a search on Proquest news and newspapers for English language. Not just America, but it's mostly America. And you can see that the coronavirus wasn't talked about much when the World Trade Organization announced the crisis. But it shot up during, C is the crash period, and it shot up really high in the crash period. So definitely coronavirus, there's no question that crash was caused by the coronavirus, but it didn't do that without an intermediary, that the crash created a narrative. It spurred narratives that scared people. And in fact, it scared a great, well, let me also look. A and B, there was not much market reaction. When the news really broke, there wasn't much market reaction. Next slide shows, you can search searches. These are the searches that people made for the term coronavirus. They hadn't learned COVID-19 yet. It wasn't even named that yet until sometime in this period. If you look at periods A and B, the reason the market didn't decline on the news is because it wasn't into the narratives. People they read, oh, there's an epidemic in China. And then they turned the page. They didn't think it was real. It was a huge effect later. Next slide. And pandemic has the same thing. The idea that it would be a pandemic just dawned on people. They weren't talking about pandemics in periods A and B. You have to be there. You try to get someone worried about the pandemic, and they'd say, what's a pandemic? They don't even know what it means. I didn't do a dictionary search, but I'm pretty sure that a lot of people didn't know what it means. And the story started developing in period C, the crash period. Next slide, please. That would embellish the story of pandemic. I like this one particularly in the Wall Street Journal. It shows someone from the West searching for ragworms and minnows to eat in China. He happened to be visiting China, and he saw these people at a brook looking for worms. You can eat worms. It's a little known fact. Remember that for the next famine. Okay. Next slide. Yeah, of course. Now, Donald Trump has been just he's a very steady epidemic because he consistently revives his his contagion by coming up with new stories on Twitter every day. It's a strategy of his. He explains it in his books, and it accounts for a very slow decay of the Donald Trump narrative. Next slide. But global warming has peaked. This is part of the story of the recent expansion. The idea that was very popular in January of in period A, and it has been declining ever since. Well, pretty much ever since. And so it's pulled attention away from other worries, and we begin to start worrying more about the coronavirus. Next slide. We'll also remember there was a face attached to global warming. It was Greta Thunberg. And you see, she has had a colossal crash. Hey, she's only 17 years old. She has a chance to come back. Donald Trump will tell you about that sort of thing. Next slide. But here's her skillful use of visual images of her transatlantic voyage. Next slide. American Dream. That's pretty steady. It's a long, slow epidemic, and it's not a factor in the current strength in the market. It's strengthened only a little. Next slide. But the American Dream epidemic has been going on since 1931, when the term was coined by James Truslow Adams in a book. Poor Mr. Adams never lived to see how dramatically it took off. There's something about this phrase, and Donald Trump likes to use it all the time. There's something patriotic at just the right level. It's just perfect. This is a product of good writers who listen to people and get a sense how to choose words. That's how narratives get started, by some kind of mutation in the story. Next slide. The Great Depression. Well, it was American greatness. Yeah, I'm sorry. It has taken off right now, and just before our election. I don't know exactly why. This is something for further research. Next slide is Great Depression. So it seems like we weren't that focused on 1929 and the years in the 30s until the stock market started dropping, and that's C in the crash period. You'll see that the stock market went up and peaked. I'm sorry, the Great Depression stories went up and peaked, and now are declining. So the decline in the Great Depression since then is a part of the reason for the stock market to be going up. Hey, we don't worry about global warming anymore, and we don't worry about the Great Depression anymore. And maybe we're even believing Donald Trump that the pandemic is fading. And so some of them were. I think this accounts for the stock market. The best I can do at this stage. Next slide. I'm sorry. This just shows how people made comparisons with the Great Depression. The left diagram was from October 19th, 1987, the biggest one-day drop. This is what was in the morning Wall Street Journal on that day. It was comparing it with 1929. More recently, we've seen on the right-hand side comparisons of the market with 2009, the Great Recession. These stories are affecting people's expectations. And we have visual images right there before us. Next slide. It's about V-shaped recovery. The V-shaped recovery wasn't talked about much this year until, of course, after the crash period. But then it became a lively epidemic because it brought back memories that are fresher than 1929, memories of 1987. I'm sorry, of 2009, which was the bottom of the stock market. And although people were very worried about the market dropping further in 2009, it actually went up, and it went up almost threefold after the March 2009. What a profit opportunity. What a miss. What a sense of regret we have. Lots of talk like that. led to people thinking that the market ought to do well now under Donald Trump, our great leader, and that's what has happened. Next slide. Quantitative easing. That's used all over the world. It came from Japan, but now on March 23rd, the Fed in the United States announced the dramatic plan of quantitative easing and light monetary policy. And that was the turning point in the market. That was the day to buy in the US stock market. But that story is fading very dramatically. And so it led to support for a V-shaped recovery. It had people involved with it. Next slide. I have a slide showing Jerome Powell, Janet Yellen, and Ben Bernanke, who are just faces that illustrate and expand on a recession, on a narrative about monetary policy. But I don't think that they are as colorful a figure as Donald Trump or Boris Johnson. So they're giving it a little support, but different. The last slide about the recent thing is the V-shaped recovery. I think maybe I should stop. I was going to say in my last slide that we need more focus groups and more research about narratives. And I expect that we'll see it because we have a vast new amount of data about narratives available. So I'll stop here. Yeah.
Thank you very much for that, Professor Shiller. That was brilliant, amazing overview of a lot of stuff. And as you can imagine, we've had lots of questions coming in, asking you more about a whole bunch of things you said and bringing up different topics. We figured this might be a good one to start on. This is a question coming from Lucy, who's reading maths at Oxford. Lucy asks, you've spoken about the need to encourage financial innovation and how it has impacted societal well-being throughout history. How can finance today help create a better society?
Okay, that's a big question. I've written a book on this too. I've written 2 books or 3 books. Depends where you count. I think it's the latest of them is called Finance and the Good Society. And so I'm thinking that there's a lot of institutions that improve our lives have been very slow to take on. And people are still exposed to accidents of one sort or another, and it's too big a subject to put in as an answer. You can read some of the Nobel Prize winners that I mentioned at the beginning. I think you have to bear in mind that these things take decades. People don't respond. You have to get the world prepared for a new financial institution or a new insurance institution. For example, to deal with inequality, which is growing around much of the world. And it's heightened by COVID-19. If you are poor in the COVID-19 epidemic, you can't take precautions as well, and you may not get as good medical care. So it matters a lot. Finance matters a lot. And I don't think the finance departments have a bit of reputation as home for the money-grubbing students who want to make a lot of money. It's even okay if you make a lot of money if you give it away eventually, I think.
Okay, question here from Yasser doing economic history at Cambridge. Yasser asks, what do you make of the uptick in the narrative of an impending financial collapse bigger than that of 2008?
Yeah, well, we've already seen something bigger. The decline in GDP is sharper than it was in 2008. On the other hand, though, this seems so different because it's caused by a disease. And you may see a cure for it. They are working hard on finding a cure and a vaccine, so it could just disappear in a year or so. But there could be. I'm thinking people are rethinking their lives at a pace that is highly unusual by historical standards, and they're thinking. The sense of mistrust is so high, and the questioning the meaning of all of this activity we've been going through. I can't predict what the next narrative will be. I wish I could. This is a big topic. It's for many people, but I think there is a possibility of a big financial collapse. I'm just not predicting it.
Okay, question from Alicia doing biology at Imperial. Alicia asks, why do we focus so much on stock market performance as an economic indicator and not real wage growth?
Okay, why do we? I have wondered that too. I think it has partly to do with a lot of people like to gamble, and we have daily observations on stock prices. And stock prices have day traders in the stock market. You have these people who trade in and out within one day. Within minutes, they're going in and out of the market. So it creates liveliness in the market. And it's a lot of people think, well, I should stop playing poker and play the stock market. It's just as much fun. And maybe I can really make a lot of money. So I think it's an accident of history. And the news media are limited in their ability to steer people toward important news. They've got to have viewers or readers. And they've learned that there are enough readers who absolutely want to know what happened in the stock market today, because that's considered necessary information. So you have to put it on your news show. So they're co-conspirators in making the stock market seem more important than it really is. It wasn't true a long time ago. In the 19th century, they didn't talk so much about the stock market. It was back in the newspaper, in the business part. So they just didn't have this attitude that we have now.
Question from Chen doing law at KCL, who's asking, with the rise of AI, whose onset has been accelerated by the pandemic, how do we best future-proof employment? You've suggested some kind of insurance product against losing your job.
Yeah, I have been proposing that we should have something called livelihood insurance or inequality indexation. Or we can have, it's not just necessarily a proposal for the government. A private insurance company could offer insurance of a new kind. And there are people talking about doing that. There are people doing new things. For example, you have computer training school that teach you how to be savvy in modern information technology. And some of these schools don't charge tuition. Believe it or not, they say, if you don't find a job that pays more than X, you don't owe us anything. And so that's a sort of insurance. You only pay if you get a good job. So that's a new model, which is just a few years old. But it's an example of they're offering insurance on the idea that you don't benefit from their program. And that really focuses attention on education. That just as insurance benefits you partly by protecting you against losses, but partly because by the insurance company having an incentive to go in and correct the dangers that you are exposed to. The same thing would happen with livelihood insurance. It would put pressure on educational institutions to be more vocationally oriented. That may not be a good thing philosophically. We can think about that, but there are lots of possibilities for new innovations in finance that will change and improve the nature of our lives.
Okay, question from Stefano, who's reading Finance at Bocconi, who asks, could you talk a little bit about the Shiller CAPE index family that you've developed with Barclays, please?
That's something I wasn't going to do, but since you asked, I was supposed to be a disclaimer, so not an invitation to a question. But if you search on Barclays and Shiller, you'll come up with a page of investment products that are value investment products that use the CAPE ratio, which I, with my colleague John Campbell, developed. I'll give you a plug for UK. UK is a value investment now. The stock market is cheap by our CAPE standard, and so you're in the right place. You're in the right place.
Okay. Question from James doing history at UCL, who's asking, how much of a problem for society do you think the growth in the wealth of the super rich is, while so many are struggling? How do you think this could be solved?
Yes, it is a problem. And it's been a problem ever since the Luddites in 1811 in the UK did a protest against new mechanical looms that were replacing their jobs. So it's a long-standing problem. It's part of the motivation for the progressive income tax and the corporate profits tax. Although they don't, it's not politically that feasible because people don't like the sound of heavy taxes on the rich and giving the money to us poor people. They want to succeed. So I think that we need to also think about human behavior and think about how people feel about welfare. We don't want to label something as welfare. So, for example, Edmund Phelps wrote a book called Rewarding Work, who had an innovative idea of not giving a negative income tax to poor people, but giving a subsidy to the hiring of them, which would be available on the corporate profits tax. The only people who would see the subsidy would be the corporations or people interested in corporations. Other people would just see if they're getting a job, that they'll compete up the wage on those jobs. There's a number of ideas, and I think this is we have to solve this problem. It is a big problem that income inequality is so tilted toward the high end.
Question from Alec, who's doing an MBA candidate at Oxford. And Alec asks, do you see economic value in cryptocurrencies such as Bitcoin? Do you see a useful role for blockchain in areas like real estate, such as tokenization of debt?
It's odd that I actually devote a chapter to Bitcoin in my book, Narrative Economics, because I've been astonished at how popular this idea is, and I note when I mention it in my class when I'm lecturing, the students become animated all of a sudden. It wakes them up. There's something about it. It has star quality, and I mean that's what interests me. I suppose there may be economic value in cryptocurrencies and blockchain, but maybe different than what we see now. But what we see now is a narrative and a lot of speculation in Bitcoin. It's not used that much for commerce yet. And behind it is a nice story about Satoshi Nakamoto, the supposed inventor of Bitcoin. The funny thing is, nobody can find him. And in fact, nobody can even remember having met him. So what's going on here? The founders of the existing Bitcoin.org have never met him. they conversed with him on email for a while, and then he disappeared. And so maybe he doesn't exist. Maybe it's a committee. We don't know, but that adds mystery to it. So it has all the good connotations. But I like to compare it in my book with the bimetallism. It also starts with the letters BI, which was a huge fad in the late 19th century. There was a London bimetallism conference in 1894, I think it was, but it got most of its attention in the US. It was just the idea of expanding the currency into not just gold backed, but gold and silver backed. Somehow that became really exciting. Everybody was talking about it. One book on bimetallism sold, it was the best-selling book in America, I think. So why did people get so excited about it? I think it's a bit of technology that most of the time technology isn't that interesting to people. And most of the time it's modified so many different times that you can't even decide which is the inventor of it. But we've got a nice sound story about Bitcoin. It's fading lately, I think, though, because of COVID. COVID has a better track record late in this year.
Question from Mark doing economics at Warwick. Mark asks, to what extent would you say the market drives narrative versus the narrative drives the market?
Yeah, well, this is a difficult thing to quantify. It definitely goes both ways. So, for example, COVID-19 is driving the economy, it put us into a recession, but the economy is driving COVID-19 because it generates fears that people don't want to spend money sequestering, and they take chances with catching the disease. So there's a co-epidemic. And it's always both ways. I'm just advocating not being so focused on only the one way. There was a big narrative explosion in the economics profession, what was called real business cycle models. And economists like to look at the market as smarter than any one of us. It's the combined force of judgment by the market. But as Keynes said, it is smart in a way. It's trying to predict its own future. It's like a game of Snap, he said. You're just trying to predict what other investors will do before they do it. And so it doesn't encourage optimism. So I think narrative, I'm trying to argue, it's hard to argue this if someone is familiar with modes of argument among economists. But if you look at other social sciences, like the history department or the sociology department, they're much more persuasive. They can be more persuasive about what's driving things because they look at what people are really saying and thinking.
Question from Alison, who's reading industrial design at the University of Arts London. Alison's asking, with global warming so intertwined with consumption and manufacturing in capitalism, do you see an economically sustainable way to move away from a product-centric society? If so, how?
Yes, that is an important thing to do. What do I have particularly to add to this? It seems to be the problem is in the United States. The problem is that the public doesn't buy it. Or a lot of the public doesn't buy it. They instead read Donald Trump's books. I recommend you read them to get the understanding of the time. He didn't write any of them, but he did dictate ideas, and it does sound like him. So he tells you, you have to show off in life. And you have to be boastful. Forget about modesty. I'm overstating him. I'm not quoting him exactly. He said, if you don't tell other people about your success, they won't even know. Don't expect them to know. You've got to promote yourself. And one of them is having the best fashionable clothes and have a big, impressive house in the right places. So you're kind of a person who knows the scene and has the best stuff. You can wear Donald Trump cufflinks, for example, which are being made and sold. So I think we have other heroes like Scott Neary and his wife, who wrote a book called "Small is Beautiful," I think, in around the 1950s, and people still recite "Small is Beautiful." But how to make that into something that wins is a difficult thing, it's not just the Americans who have trouble being convinced. Sustainability is about something in the distant future that hasn't happened yet. It's easy for people to say it's not going to happen. You might take a career in journalism and write about these things. Or there are other ways to get narratives started, but that's what one has to do. Greta Thunberg is a great model.
Yes, definitely is. It's a question from Christian, who's doing engineering at Edinburgh. Christian's asking, how successful do you think Trump has been in controlling the narrative? The best out of anybody? A lot of people are saying ever. Bigly.
I hate to I can think of some tyrants that I would compare him to, but I won't do that. That's too offensive. I've talked to a lot of Trump supporters, and I'm finding that they're going to vote Trump no matter what this time. They are very hardened in their position. But I think that there could be a softening and more respect for the issue of global warming. It may be an anomalous situation. It reminds me of, in the United States, Senator Joe McCarthy in the early 1950s wanted to put a lot of people on trial for being communists. And for a while, he seemed to be invincible. But it mellowed after a while, and you don't see that. I mean, he was accusing people of being communists who were the most remote from being a communist. And that's part of what Donald Trump does too. It's similar. He says socialist. They don't say so much communist. So Trump has been very successful in controlling the narrative in the United States, among a part of the United States. In my state of Connecticut, I hardly ever meet anyone who's pro-Trump. It's so geographical. It's stunning. But his success was done at great risk. I don't think he thought he would actually win. He was promoting his career, as he explains in his book, before the election. And then, surprise of surprises, he actually won. But I don't know that it's a coherent strategy. It's a high-risk strategy. As Donald Trump says, most people are constant. I'm not quoting him exactly, but in one of his books, he says, most people find it very difficult to accept the stress that risk-taking involves, and they want a simpler and quieter life. So he is a risk taker, and there are presumably many more risk takers like him who gambled and lost. He gambled and won, but don't expect that to be a reliable strategy. If you want to be Donald Trump, you have to expect a stressful life, and I don't think you want to do that. It's too, unless you have a very strong constitution. It's a difficult life.
Okay, question from Johan, who's an MBA candidate at Stanford. Johan's asking, could a Green New Deal be a big win for America? What is your view on it or other proposals for dealing with climate change?
Yeah, I think there are elements of the Green New Deal. I can't go through the points point by point. It might have been too aggressive to get by anyone in the U.S. at this time. But it's a thought process that I wouldn't rule out completely. Yeah, I'm seeing signs that it's generating ideas, but we have to go lightly for political acceptance. We can't go too fast.
Question from Susanna, who's doing economics at Erasmus University Rotterdam. And Susanna asks, what role do you think should economics education play in avoiding mistakes like a financial crash in the future?
Well, I'm an advocate of, I do it. By the way, I have an online course. It's free on Coursera, Financial Markets. And there are many other places. A lot of my students in this course, it turns out, are not young college students. They're older people who are maybe, some of them nearing retirement, and they think, I better think about finances. So they take my course. So maybe one has to remember that it's a lifelong learning is important. And your college education is not the end of your education, hardly. So I still remember things I was taught as an undergraduate 50 years ago. I was just thinking, they did make an impression on me. A lot of it is, I can't remember where I heard it, but I think it was as an undergrad. I'm still thinking in those terms. So yeah, financial education is important. Not to be afraid of science, to be able to trust some people with financial solutions. And not be fooled by crazy ideas. So it's important. And I think that it's becoming more proliferated. But you also have to know in education, you have to also know history and sociology and psychology in order to understand financial markets as well. These financial crashes are related to psychology.
It's funny you should mention your course, because here's a question from Karam, doing economics at Warwick, who says, hi, Professor Shiller. I enjoyed taking your financial markets online course. In your opinion, is it a concerning issue that the US stock market is booming during the pandemic?
Yes, it concerns me. And I think that there is a danger of another correction. But so far, we've seen a tumultuous, in the last 20 years, which is the memory of most people, with the exception of the Great Depression, which they still remember. We've seen big up and down. There was a big crash from 2000 to 2002. And then another crash from 1997 to, I'm from 2007 to 2009. Did I say these right? And so we're at record highs again, and a high price earnings or CAPE ratio. So yeah, we're at risk for another crash. But I hesitate to forecast it because it's very. My predicting regression for the next 10 years it only explains a quarter of the variance. You can't predict when these things will happen. So it's pretty safe to say there will be after this boom, there will be a correction or a bear market. But it's not easy to say exactly when it's coming. So it may not be imminent. And we may get a boost of confidence from if indeed we get a vaccine and or a treatment that works even better.
Question from Sam, who's a PhD candidate at Cambridge. And Sam asks, what are your thoughts on China's ambitions with the digital yuan central bank digital currency and One Belt, One Road? Might it challenge the US dollar hegemony as a global reserve and global trade currency?
Well, I'm not up to date on the China proposal, but other governments are interested in, notably the Riksbank in Sweden, in digital currencies. And it seems like we're moving to a more electronic age, and there will be revisions in our currencies. In fact, you probably don't even use paper money anymore, or not very often. and it's important that there's government input into the process, because we don't want something that could falter and fail on us. And we haven't figured that out. So I don't know what exactly the Chinese government is doing. But as far as the US dollar hegemony, it's not something that will last forever. And the world is changing all the time. So I wish them luck with their new currency.
Question from Victoria, who's reading law at Yale, who asks, how do you suggest best safeguarding economies during a pandemic with minimal unintended consequences, balancing public health with economic well-being?
Okay. So I get a lot of difficult questions. Ever since I won the Nobel Prize, I get questions like this. There's a fundamental issue, about how to handle a pandemic if closing down creates economic suffering. So it has to be done. Very carefully. But handling I don't know what to say. It's a complicated thing, but it is well placed to have to some degree of shutdown, especially as cases mount, because it gives people time to develop a better treatment or a vaccine, and it will save lives. So it's lives versus economy, and I know that I tend to favor lives. But another thing is that the policy has to be also modeling the behavior and doing things like wearing masks. One reason, part of my motivation for putting the first slide up of the new Nobel Prize winners on the morning of the prize announcement, both wearing masks, is that I think it's a sign of enlightenment, wearing a mask, because if people like them set an example, the people will be more willing to do it. Example setting matters, and Donald Trump is wearing a mask now sometimes, so give him credit for coming around, maybe, but he set a very bad example. A lot of the lockdown is best left to the individuals. They'll choose to stay home or to stay covered if they think they're contagious. So people who do that, modeling rallies at the time of a pandemic is inimical to that cause.
Growing slightly conscious of time, do you think it might be okay to do 3 more questions?
Sure.
Okay, brilliant. Here's one from Christopher, who's reading maths at ETH Zurich. And Christopher's asking, can stock markets outperform the real economy as measured by GDP in the long run?
They tend to have different growth rates. I have to think about it. Stock market is a total, it depends on which kind of index you're using. They have what they call a total return index, and they have a conventional, a total return index reinvests all the dividends. It's like following a portfolio which has every stock in it, and it reinvests all the dividends. That has grown, total return indexes have grown much faster than GDP. Because it's not everyone does that. You don't just reinvest all of your profits into the stock market. So they're fundamentally different animals. And so the conventional stock market, actually, if you don't look at total return, if you look at a conventional index, real GDP and the real stock market in the United States have grown at similar pace, about a couple percent a year over the last century. So I think that the best answer to your question is total return indices always tend to outperform the GDP, but conventional indexes, it's iffy. They don't really outperform GDP. They give it to you in dividends, which is different.
Question from Princewell, who's a recent American university graduate and a financial analyst at JP Morgan. And Princewell's asking, is capital market behavioral psychology still very important for capital markets? Are markets mostly driven by fundamentals or emotions? And how can you beat the market?
Well, I think behavioral finance is one of the great events in academic economics. That we had people like Keynes, who was widely admired, who said it was behavioral what drives markets. But the economists as a whole didn't really chime into that in any great numbers until after 1990, and that was a revolution in economics. So you're asking, are markets mostly driven by fundamentals or emotions? I think of it as mostly emotions. And by the way, some people say interest rates drive markets, changing interest rates. But even those interest rates are feedback from the central bank feedback from their sense of the economy, which is driven substantially by emotions. So there are lots of emotions. It's not just fear versus greed. It's, for example, a sense of live and let live, or a sense of appreciation of other people. There are times when, like the Roaring '20s in the 1920s, when people were very aggressive and optimizing, and then in the 1930s they decided that life isn't all about that. I talk about this in my books, my latest book. So it's both. It's both fundamentals and emotion. I wish I could say it in a more crisp way than that. If you want to beat the market, and I think you can beat the market, not consistently, not every time, but in the long run, if you want to devote energy to doing that, it's not as rewarding as you might think, but you can beat the market. And you probably want to know about both fundamentals and emotions.
Okay, we thought this might be a last question to end on, coming from Jake, who's reading Economics at LSE. And Jake says, thank you so much. Thank you for such an inspiring talk. I would love to know which economists you take the most inspiration from and which other people you looked up to most when younger.
Well, I can go back to my college years. I was an undergraduate at the University of Michigan. And I was thinking back to my college teachers. I had one professor there, Kenneth Boulding, who said a lot of interesting things. He was a moralist, and he talked about, he said economics is a moral science. They try to make it into something that is purely technical, and it can never be that, because economists study, he put it that economists' purpose is to change the world that they study. And they're supposed to have an idea for a different world where it would be better. He might have been my most influential economist, because I saw him when I was a teenager. And so it left me all every year since. But there are a lot of economists. But I think one thing is that you have to appreciate your teachers and try to get involved in communicating with them at your local college. And Keynes, by the way, I mentioned one more. Keynes, who was not at LSE, he was at Cambridge, but he launched he went viral among a lot of good thinking people. And he, even though he never really changed a lot of things that happened in the profession. He was a force for creative thinking. So maybe Boulding is my local favorite from my undergraduate days, and Keynes is maybe my famous favorite. Okay, never met Keynes.
Well, on that note, thank you so much, Professor Shiller, for sharing so much of your time and your thought-provoking insights with us. We all highly recommend that you read Professor Schiller's latest book on narrative economics, how stories go viral and drive major economic events. We've included a special discount code on screen and below in the description. It really is an excellent read. And thank you also to everyone watching for all your varied and challenging big questions. We look forward to welcome you all again soon at our upcoming events. Thank you very much again, and goodbye.
Thank you.